Inflation is running hot, war has begun, investors are buying homes like mad, and according to some, real estate is softening. That's what we're going to dive into in today's video. And when the history books write about the 2020s, they're going to wonder, how in the world are we still a functioning civilization? PCE, personal consumption expenditures, came out Friday, and that's the primary indicator for the Federal Reserve and Jerome Powell to measure inflation. And it came out at 5.2%. And yes, that is bad. It is at a 39-year high. It wasn't this high since the early 80s, 1983 to be exact. And that further proves that inflation is running much hotter than initially expected, or what was told to us back in last summer when they said it was transitory. So what does that mean for you? Well, it means that things will continue to get more costly. A loaf of bread will be more expensive. That steak you want to buy, it will cost you more. And if Americans keep spending like we currently are, it's only going to get worse. Granted, the average American worker saw their wages increase over 9% in the past year. That's a pretty big jump. So many Americans are spending more money because they have it, and they aren't really thinking or worrying about the long-term implications. What that is doing is creating a vicious cycle that will ultimately harm us all. Yes, I said harm us all. I'm not trying to sound doomsday or anything, but the cycle of manufacturers and stores raising prices and consumers continuing to buy those goods quickly and without hesitation, and then the manufacturers continuing to complain about their lower profit margin will only cause them to rise their prices even higher. And that cycle will end with the average American suffering and losing the savings that they accrued over the past 2 years because the average American did not fully appreciate the dynamic at play and see this revolving cycle. So how do we solve this? Not until people stop spending will prices go down. But telling people who have money to stop spending their money is like telling my 3-year-old to share with her sister. It's a fruitless effort. Real quick, for those of you who are new to the channel, I am Sir Ashley, and on this channel we talk about real estate and money. And if you gain any value from this content, please do me a huge favor, hit that like button and consider sharing this video with others. Also, if you're interested in the Carolinas and house tours of properties in the Carolinas, you can check out my other channel. The link will be in the description below. Now let's move on. We also have a war breaking out, and we will have to come to grips with the realization of this war on the world's economy and how it will affect us Americans. Well, on the first day of the war, mortgage interest rates dipped slightly, but have since gone back up to their steady climb. But before we think that things are going to go as status quo, the war in Ukraine may actually hinder Jerome Powell and the Fed from making that 0.5 point increase in March. So that may slow down the rate in which interest rates go up. But the impact of the war will most definitely increase inflation and cause further bottlenecks in oil, supplies, and goods all around the world. Earlier this week, there was an article highlighting that mortgage applications dropped to the lowest level in 2 years. And there are 2 reasons for this. 1, the rise in interest rates, and then 2, the lack of inventory. Now, the rise of interest rates and lack of inventory are working together to contribute to the steep decline in mortgage applications. Now, I was recently listening to someone and he had this example. So let's look at some numbers. If someone had a $2,000 a month budget to spend on a mortgage payment, at a 3% mortgage interest rate, which it was last year around this time, actually it was below 3%, but let's just go with me. A person could buy a home worth $474,000. And at a 4% mortgage interest rate, that home that person could buy would have to cost $418,000. Now that is a significant jump in what your purchase price can be with a 1% interest rate increase from $474,000 home to a $418,000 home. And today's interest rates are right around 4.2%. But let's take this a step further. If mortgage interest rates got to 5% and that family still had a $2,000 a month budget to spend on their mortgage, the home that they could afford would have to cost $372,000. And this is why I've been telling everyone to buy sooner than later, because your purchasing power will decrease significantly as interest rates go up. And if you've been looking at homes in my area, there is a huge difference between home prices that are priced at $474,000 and homes priced at $418,000. And in some instances, it may mean traveling an extra 30 minutes on your daily commute to work. But the main challenge that is allowing prices to continue to go up is the lack of inventory. Because even though mortgage applications have decreased, there are still many, many more buyers that are looking for homes and in the market to buy a home than there are homes on the market for sale. And I'm sorry to tell you, but we can't look to builders to supply the market with inventory, because the builders this time are being very methodical. They're not doing what they did in 2006, 2007, and 2008 and just building tons and tons of properties and releasing them all at once. I recently had 2 builders this past week tell me they're pushing back release dates of available homes because each of those builders had one inventory or spec home left to sell. And once their respective inventory homes sold, then they would release 5 more homes for sale. And they would not put any more else on the market until those 5 homes sold. And homeowners are not going to put their homes on the market for 2 reasons. For starters, homeowners see how hard it is to find new homes. So why would they subject themselves to this potential headache? And number 2, and probably the most important reason why they're not going to sell their home, is because they refinanced their home in the last 2 years. And because they refinanced their loan in the past 2 years, they have a ridiculously stupid low mortgage payment because they got an interest rate in the 2s or 3s. So to subject themselves to this crazy housing market to find a home that is not only more expensive, but they will also have a much larger interest rate, it will be silly for them to do so. Why would they trade in their 2.7% interest rate for a 4.3% mortgage interest rate? It doesn't make any sense. So a lot of homeowners are not going to list their homes on the market, thus contributing to a low amount of inventory. Now, let's talk about foreclosures. In one of my last videos, I talked about how foreclosures aren't picking up and how foreclosures will not have an impact on the supply-demand equation. And I got a few comments with certain people disagreeing and telling me I didn't know what I was talking about. And please leave your comments. All comments are welcome. But this is where numbers and math really come into play. So let's break it down. Yes, there may be 1,000% increase in mortgage defaults compared to this time last year. Because remember what we were going through last year. There may have only been 5 mortgage defaults last year. So if you add 1,000% increase, you still only have 50 homes that are in default. So let me backtrack a little bit to this one comment that Nicola left. This is where verbiage and numbers matter a lot, as well as equity. Please take a look at her comment as is brought up on the screen. Now, according to the US Census.gov, and this is 2019 data, so I understand that it is dated, but it's the most relevant information I could get from the US Census. There are over 600,000 housing units in Philadelphia. So that 200 homes in default that she mentioned equate to about 0.035% of the homes in Philly that are in default. And according to the Bright MLS, which is the Philadelphia MLS that compiles all the housing data for that area, in the past 2 years, homes in Philadelphia County gained on average 25% equity. So of those 200 homes in default, let's assume that half of them got 25% equity in the past 2 years. Do you really think that those homeowners who have equity will allow their defaulted homes to actually be foreclosed on. There's a difference between being in default and being foreclosed on. If a homeowner has significant equity, the chances are of them getting foreclosed on is slim to none. So again, foreclosures will not be the saving grace for the housing inventory or saving the housing market. Now let's move on. For buyers in the $600,000 price point and below, I don't see any real relief coming because it's still a very, very competitive market and a lot of people can still afford those mortgage payments. I have been seeing that homes that are right around $700,000 or above are starting to sit on the market for significantly longer than before. In fact, in my area, there is a beautiful 5-bedroom home that is over 4,100 square feet, and it's been on the market for 19 days. Now, I get it. In the real world, in a normal market, 19 days is nothing. But in this crazy real estate market, this home would have been snatched up in a day or two if it were spring or summer of last year. So the higher interest rates are causing higher price homes to sit on the market and thus softening the real estate market for higher priced homes. Now, I have a statement and then a question for you all. So please leave your answers in the comment section. In the past 3 months, real estate investors have bought a crazy amount of homes. In fact, 1 in every 5 homes sold in the United States sold to an investor. Why is that? Here you have all these YouTube channels and people telling you that a housing crash is coming. Well, why are all the big money investors buying homes? Yet people are telling you, the average person, to be scared away from buying. What does the big money or the smart money know that the average person does not know? Please leave your comments and your answers in the comment section below. All right, inflation is going up, mortgage rates are going up, but it may be slower than expected because of the war in Ukraine, and higher priced real estate is sitting on the market just a little longer. If you want to keep prices down, home prices and goods prices down, it's simple. Convince everyone to stop spending money. Because so long as people continue to buy goods and buy homes, the manufacturers and builders will keep raising prices until the market tells them that they can't raise prices anymore because people will not buy them. I hope this has been helpful. Be sure to check out some of my other videos where I talk about real estate and money. I'm Sir Ashley. Talk soon.